Good morning, friends. Leigh Brown and Joseph Baker coming at you live from the 𝙁kitchen here in our Concord RE/MAX executive office. And by the way, if you've not been up to our office, it's frankly the most Instagrammable place, although Joseph said it's the gram now. I'm obviously the older of the two of us, so I don't know all the hip, cool language. So what you can do is come visit us for your real estate needs. And by the way, if your mama or your grandma are from the Charlotte region, they'll remember 𝙁from WBTV. So if they just want to come by and see the kitchen, just come by during business hours and make your picture in it. It's so cool. And by the way, we're pretty sure that this stove right here is worth far more than we are because it's original and still works. But don't be trying to buy that. You can buy a house from us, but not our 𝙁stove. So Joseph, tell our viewers who you are and why you're in the kitchen with me today.
So my name is Joseph Baker. I'm a loan officer with 𝙁𝙍𝙍𝘼. We've been in business since 1960, so we've been through quite a few downfalls.
Your company's older than you are.
They are way older than me.
But you're not Joe. He is
I am
not Joe.
Joe.
He is Joseph.
I am not Joe. I would be Joe if I started when 𝙁 started.
True.
We are located in South Charlotte, our office. We're down at Carmel and 51. We have about 10 loan officers in that office, and we're currently growing in Charlotte, so you're probably going to hear more of 𝙁 as we go along.
And we're glad to have them as partners because, y'all, one of the things that we look for in our lender partners is somebody that provides amazing service. And Joseph and the other folks at 𝙁, they are Johnny on the spot, responding and taking care of you in a really kind way. They don't jack you up on fees and rates because if they do that, they are not going to be on our list. And they're really friendly and nice and help us with our client events so that they can be helpful to you even when you're not buying and selling, because that's really important to us because, as you know, we love answering your random questions when you have them as long as you call us to buy and sell when that day comes. So anyway, we're going to talk today about money. So before we start, I got to tell y'all the first thing is if you're buying real estate with cash, we love you. So don't think that we don't love you. But this post, we're going to talk about mortgages and financing options. So if you're a cash buyer, go ahead and call us and we'll help you. But you may find out actually that you could leverage yourself differently instead of using all your cash on one purchase. There's ways to use your money wisely, but it's ultimately always your decision. So that's the first thing is if you're paying cash, we'll help you, but this is a different post. So Joseph, let's start off with the big topic that's going on right now, especially with people in your age range, because as you can probably tell, actually you can't from there because we're far away from the camera. He doesn't have lines here, but he's a millennial. I know. And millennials, y'all are the biggest generation. You're bigger than baby boomers. And you are the ones buying your houses for the first time. However, we've been in a decade now of ridiculously low interest rates, like free money.
Very low.
And so we have a generation of your friends that thinks 3% on a 30-year fix is normal. And now where are we at today? Be a rates spitter outer. What's our rate today?
Average right now is 4.875.
So call that 5% because you always round up, and that way if they move a little bit, you won't be stressed out. You never round down when you're looking at interest rates as an estimate. Wouldn't you agree with that?
I agree, and we are still historically low right now.
Exactly. So that's the thing, y'all. You think 5% is high because you heard about 3%. Stop. The average historic 30-year rate is 6.5% to 7%, depending on whose numbers you use. Y'all, I mean, I won't tell you how old I am. Only Claire all knows. But here's the thing. When I bought my first house about 20 years ago, my interest rate was 11 3/4. I was glad to get the mortgage because I was ready to be committed to owning a home. And one thing I can tell you that's been the same across all generations is that it's scary as hell the first time you pull the trigger on a mortgage because you go to closing and you look at that document and it says your last payment is in 2000. Well, this would be 48 right now, and you're going to go, it's always scary. So don't let numbers scare you. What we want to look at, and what Joseph can explain to you, is your budget. So you got to look at what's coming out of your pocket monthly. And when y'all look at what you're paying in rent, it's out of control right now. They are charging some really jacked up rents here in the Charlotte and Concord market. So let's talk a little bit. If you're a first-time buyer, and you're watching this and you're thinking, okay, Leigh, I'm going to push past my fear and pull the trigger. What's the first question they should ask you?
How are you going to get me my lowest monthly payment?
Lowest monthly payment. What's in a monthly payment? Because if you go online, look, y'all, let me tell y'all something right now. I know you're online watching us, but you do not get a mortgage from a website. They do not know you, and they are not going to ask you all the correct questions. They're going to ask you some high-level questions. Those aren't your neighbors. People like Joseph, that's your neighbor. He lives here. You talk to a local lender, and the reason I give you a name is because I know who's shady and shifty out there. I know who's squirrely. This is not that guy. So start asking good questions. And so now we're going to go ahead and ask you, now that I've diverted you, what's in the monthly payment?
So the first thing that I'd like to start out with is everyone wants to know what determines their rate. So the first thing that's going to determine your rate is your credit score. And I tell all my clients, don't depend on Credit Karma for your credit score. And the reason being is there are multiple FICOs that companies pull, whether it be your mortgage or your car or Credit Karma. It's all different FICO scores. So your mortgage is the biggest purchase you're going to make, so you need to go ahead and have your credit pulled by whoever your mortgage lender is going to be. That's going to give you a true score, and they're going to use the middle of your 3 scores. In doing that, they're also going to look at your debt to income. They're going to look at your credit report, determine what your liabilities are, and some typical things that are included in your liabilities are going to be credit cards, car payments, student loans, some of those major liabilities. Collections are going to be on there, stuff like that. So once they determine your rate, then you're going to get a principal and interest payment. So that principal and interest payment is determined on your rate and whatever your purchase price on your home is. So you take your purchase price and you take out whatever your down payment is going to be, and that's going to give you your loan value. So that loan value is what we're basing your monthly payment off of. In addition to that, the majority of mortgage companies are going to require you to escrow your taxes and insurance. And what escrow is they take it and they divide it into a monthly payment, and they put that monthly payment into an escrow account and they pay it for you, so you don't have to worry about the taxes and insurance each year.
They're holding back your money. It's like when you got a paycheck once upon a time and they withheld taxes. Y'all remember that? That's kind of how escrow works. They're holding your money back so that you won't get irresponsible and forget about it.
Correct. And in this market, 80 to 85% of mortgages are less than 20% down.
Which is cool. See, y'all
Yes.
heard you need a 20% down. That is an urban myth or urban legend. Which one is it?
I
Myth.
think
Urban
both.
myth. You don't need 20% down. Did you hear Joseph? 85% of loans-ish are less than 20% down. You can do this.
Yeah.
And I even forgot about the I. We did principal and interest. There's PITI. I distracted them. It's my fault.
Yep, and the PITI will be the combination of everything. So you have your principal and interest payment, you have your taxes, you have your insurance, HOA fees if the house is in HOA, and then you're going to have mortgage insurance. And that's where we really get into and drill down onto what is going to be your lowest monthly payment, because lowest rate does not always mean the lowest monthly payment.
Did y'all hear that? It's not just about the rate. It's about the program, it's about the down payment, it's about the fees. It all adds up, and that's why you need a human to talk to figure out the process.
It is, and you want a lender, whether it be myself or any other lender out there, you want someone who's going to sit down and talk with you and spend some time with you. Because if you're putting less than 20% down, your lender should be looking at your mortgage insurance and saying, hey, what is the best way I can approach this mortgage insurance? Because there's several different options. Your standard option is going to be your monthly mortgage insurance, but you have financeable mortgage insurance, and you can also pay your mortgage insurance up front, so you don't have to worry about it. And that mortgage insurance is also determined by your credit score, and it's determined by your debt to income as well, similar to the rate. But I've had multiple clients that I've had come to me with, let's say, an average of 5% interest rate, and I'll look at the loan programs for them, and it comes back that a 5.25% interest rate is actually cheaper because we can go with financeable mortgage insurance. So they're actually saving $80 to $100 a month by having a lender sit down with them and really drill down into what's your best option and what's the best loan program for you, because all loans are not for everyone.
So look, y'all, you might be throwing up in your mouth a little bit because Joseph is talking about a lot of money terms. That's why you sit down with somebody. So let's break this down into a couple of small things. First of all, you mentioned debt to income. Explain the debt to income ratio and how that works.
So we take your gross monthly income. We don't look at net, we look at gross. And we look at your liabilities. So we go back to looking at your car payments and your student loans, credit cards, anything that's going to be on your credit report. You know, stuff like your power bill and your gas bill and cell phone bill, stuff like that's not going to be on there. So what we'll do is we'll combine all those liabilities that are on your credit report, divide them by your monthly income, and that's going to give us your debt to income ratio.
So help us out here. If somebody is looking to buy a house and they have a pile of medical debt, let's say they went through a massive illness and they've got medical bills out the wazoo, how do you, a lender, treat medical debt? Is it treated differently?
Depending on the loan program and the amount of medical debt, we can delete medical collections off of a credit report and not count that towards debt to income.
So did y'all hear that? Even if you have medical debt, you might still be able to buy a house. So this is why you can't make assumptions about what your situation is until you talk to a pro. Now let's talk about student debt, because we know that our millennial population is swamped in student debt, way unlike my generation, because I mean, I paid for college by bartending. It'd be almost impossible to do that now unless you're a really high-end bar with people that tip really well. But how do you treat student debt for somebody who's, say, 23 years old and fresh out of college?
So this is where it also helps to have someone to sit down and talk to. I've had multiple buyers come to me and they're like, I'm overwhelmed with student loan debt, but I don't know what to do. I really want to buy a house. I pull the credit report and see that their student loan debt is 15 different line items. Well, I have them call the student loan company and they combine all of that student loan debt into one payment, and they'll give them a lower monthly payment than what they're paying if they pay each separate line item. So that right there would decrease your debt to income ratio. So it's all about having someone that's familiar with that, a professional and expert that looks at that every day, sit down and say, you know, this is reasonable or this is not reasonable, and here are some options for you, and give you some type of guidance and give you some type of direction to get you prepared to buy a house. Because I get people all the time that come to me and they want to buy a house, but they're just not quite ready. Put a 60 to 90 day plan together, and all of a sudden in 3 months they're ready to buy a house and they're making an offer on it.
Now listen, did you notice that he's finding this information by looking at your credit report? I talk to a lot of home buyers, y'all, who are afraid to have their credit pulled because they heard that a credit pull is going to hurt their score. However, a professional like Joseph can't give you the best information without pulling it. So Joseph, what do you tell a buyer who's freaked out about their credit score getting affected by a credit pull? What's the answer to that, and how much of an effect is there?
There's very minimal effect when it comes to mortgages. Different types of credit pulls, whether it be a credit card, car or a mortgage, they can affect that credit report by an inquiry differently. So most credit cards are going to affect it the most. They're going to bring that score down the most. Car payments are...
Like how much? How much does a credit card bring it down?
I'd say 10 to 12 points on average.
Look, y'all quit getting a credit card when you go to the mall in every store to save 10%. That's killing your credit score. Stop it. Stop it right now.
Yeah, and the difference is that, you know, a mortgage could, depending on the credit company that they pull it from, it could be minimal at 2 points or it could be 4 points. So you're not looking at something major. And then you have a 30-day period once you get it pulled the first time, where if you get it pulled again by the same mortgage company or a different mortgage company, that's not going to affect that score.
So for the same purpose. They have 30 days to pull that report again for the same purpose.
Correct.
Y'all, see, don't be scared to pull your credit. I know that a lot of what happens when it's time to pull your credit or talk to a pro like Joseph is your fear of looking at your finances. Because one thing we do know about folks in, well, not just in the Concord area, this is not unique to us, it's all over the country. There's definitely a fear of looking at money because you're afraid of it. But what you have to do is get really honest with yourself and look at your income, look at your debts, look at your credit score, and then you develop a plan. So Joseph, let's jump into a different area here. We've talked about credit score multiple times. You know, they're looking for the median out of the credit bureaus, that they can have it affected a little bit by pull. Give our viewers 3 ways to improve their credit score if they don't like what they find.
So you can, one, if you don't have enough credit, you can go pull a different credit card.
Tell them what that means, you don't have enough credit.
So credit is affected by your trade lines, and what trade lines are essentially things that are on your credit report. So you go get a credit card, and they send you that credit card, and you establish that line of credit. That becomes a trade line.
So look, that's the amount of money you could borrow. Let's just turn this into regular people terms. You get a Target card and it's got a $5,000 available balance to use. That's what he's talking about. So $5,000 is how much they'll let you borrow.
That's how much they'll let you borrow, and the less that you have on that balance, the better your score is going to be. That means you have more available credit available.
But But don't they need to use some of the credit line to improve their credit score? Because there's an old story that says if you have $5,000 available and you don't use it, it can hurt your scores. Aren't you supposed to have a small balance on it?
It can, and what I tell a lot of my borrowers is to go get a secured credit card and start using that. Use it for gas, use it for groceries, use it for your everyday means that you're going to be buying anyway. Go ahead and get that first bill from them and pay it off. So don't pay the minimum payment due. Just go ahead and pay it off. That was your groceries, that was your gas anyway. So just take that money out of your bank account and go ahead and pay that off. And what that'll do is that will start establishing payment history, which kind of branches me into number 2 of what's going to affect your score and improve your score. If you don't like what your score comes back as and you have established credit, you may want to look at your payment history as well, because 30-day lates, 60-day lates, 90-day lates, those are the biggest hitters on a credit report.
So pay your bills and don't spend it if you ain't got it, is what it boils down to.
Correct.
But you get what they're looking for, y'all. They're looking for your level of responsibility. So if you borrowed $100 and you paid $100 off, that shows that you are responsible with your money. If you borrowed $100 and it took you 3 months to give it back, you're like the cousin nobody ever wants to see coming to Christmas, because you know they're going to ask you for something and they're not going to give it back. So do not be the shifty cousin. So give them a third tip for improving their credit scores.
So the third tip is to have your lender tell you what's in collections and what's delinquent.
Oh, can they still buy a house if they have collections and delinquencies on their account?
They can, and depending on the amount of collections, we can sometimes delete those off too and not use them as debt to income. But the biggest thing is they're going to affect your score. So you want to go ahead and get those things settled up before you jump into the mortgage process, because once they're there, they're there. I tell people all the time, you've got a $400 collection, and they're like, well, I didn't even know about it. And now you know. We'll call them, talk to the collection agency, say, I'd like to settle this in full. Would you mind deleting it off my credit report? And 8 times out of 10, you call them and you're super nice to them, and you ask them, if I pay this in full, will you pull it off of my credit report? They'll do it for you.
Did y'all catch what he said though? When you call them, be
nice.
super nice. Don't be a nasty pants yelling at people. People do not do nice things for you when you're hateful. But if you're sweet and kind, people love to help other sweet and kind people. Now let's answer me a question. If somebody gets $400 taken off of their report from this old collection, how long does it take their score to rebound?
Typically about 30 days. But if you have a lender that will do a rapid rescore for you, they can bring that up immediately.
Is Guild Mortgage a lender such as that?
We are.
Oh, ta-da! So look, it's another reason to use a really great local lender. They have ways to help you get things better, because we don't expect you to be perfect. And you got to remember that about mortgage world. There's too many people out there saying you need an 800 score. We love people with 800 scores, but that's not normal to be that high. And 20% down sounds awesome. That's also not normal, because we know that you're living a life, and especially if you're a young person, new married, new kids, or thinking about that life change, your money is going in a lot of different directions, so we'll help you find ways to make this happen. So let's talk about that person who's buying their first house, and now we told them you don't need 20% down, and they know their credit score is reasonably decent. So let's call them a 700 credit score. They're solid. How can they get into a house? How much money do they need? In our market here in Concord, average price is around $220,000. So 1% of 220, math geniuses, I know y'all can do that in your head, is $2,200. So how much do they need to have available to put down? And is that the total amount you need to buy a house? How do they figure out the nut to save up for?
So depending on your credit score, a lot of people don't know it, but there are conventional loan programs out there that only require 3% down.
Conventional means it's not a government-backed loan such as FHA or VA or USDA. So when we talk in terms of conventional versus these other programs, it just takes out one of the government hoops.
That's correct. But there is also the FHA that's available.
We do love FHA.
And they have lower rates.
But they have a little hiccup.
They do. Mortgage insurance does stay on the lifetime of the loan for FHA.
And on the side of the realtor over here, it comes with what we call non-negotiable repairs. So when you buy a home using an FHA loan or a VA loan, there's going to be an inspection done so the government can make sure that your house is what's deemed to be safe. And they look for things like handrails, they look for things like peel and paint, windows that are operational. So those things can add a hiccup, but as Joseph mentioned, it's a lower rate. And we love what FHA has done for home buyers in America because it's made it possible for a lot of people.
They do, and it's only a 3.5% down, but don't get scared away from the FHA repairs as well, because most buyers, I know myself, if I go into a home, there's moisture in the crawl space, or there's wood rot on the outside, or there's a handrail that's missing that's unsafe. Those are things that I'm going to be asking to have repaired anyway. So it's not as big of a deal as a lot of our agents look at. A lot of our sellers really shy away from FHA loans. And FHA is a really good loan, and it's really easy to close. We can get it at the closing table quick. And it's very beneficial for our buyers that are first-time home buyers that are first jumping into a home where maybe your debt to income's a little bit higher. So conventional, I don't want to confuse everybody too much, but conventional, we can get them approved up to a 49.99% debt to income on conventional.
You hear that? So if you've got a little bit of money riding around on your credit cards and your car and your student debt, that could be an option for you.
It is, and you're not out of the ball game once you hit that 49.99%. I've got clients approved and closed at a 57% debt to income ratio for FHA. So that government-backed loan allows a little bit of leniency for us on that. So that's where we want to, tell our clients, don't stop short and say, I'm not ready to buy a house without having a lender look at it, because they may be able to make it work. And we may be able to put you in a situation where you are buying your house and you're paying a mortgage instead of paying $200 to $300 more a month for rent.
And I'm glad Joseph said that. We're not trying to tell you to buy what you can't afford. But if money's already leaving your pocket at a really high rate because of rent, let us sit down with you and compare apples to apples, because if buying would be less than rent, then that extra $200 you were spending on rent, you could use that to start paying down some of this debt. Because one thing that we'll provide as your realtor and lender team is some good, sound mama advice to say, here's how you're going to get yourself in a better position for the future. We do not want you to be at a high debt ratio forever. It's awesome to find solutions for you, and nothing makes us happier than a buyer who suddenly is able to pay down their own debt just because they bought a home, which sounds crazy, but it's possible. So just ask lots of questions. Now I want to jump over into something else that we've briefly mentioned. We talked about how FHA is a loan program that has lots of extra perks in it for first-time buyers. There's also the VA loan program, and I, for one, am so appreciative of everybody who has served this amazing country by being in the military in some way, shape, or form. The VA are the veterans loans, and in the past, as in like 15 years ago, they were awful. They were hard to get through the system. But now, Joseph, wouldn't you say VA are some of the easiest loans we have to process?
By far the easiest. They're a breeze.
It's the one thing the government gets right for veterans is the VA loan program. And why should veterans look at them?
No percent down.
The first time. They get expensive the second time you use it because it
expensive
costs, but it's still worth looking at. And if you're a home seller and somebody brings a buyer to us that has a VA loan, we celebrate, because first of all, that means the seller is able to help somebody who served our country, and second of all, we know that the loan process will go fairly smoothly. And in the past, it was kind of a pain because you're a veteran, you had to go chase down this piece of paper called a certificate of eligibility. But now how do they get it, Joseph?
They order it online.
Yay, internet. That's where the internet is totally our friend, is on the VA loan side. So give them something they should ask if you are a veteran or spouse of a veteran. What should they ask you about loan programs for the VA?
They should immediately tell their lender that they're a veteran, and the lender's going to ask them for their DD-214, which is for the people that weren't veterans. That's a document that states that they were in the military, and it states how they were discharged and everything on it. So with that document, we submit it to the VA, and we order their certificate of eligibility. The certificate of eligibility tells us what they're qualified for.
Hear that, y'all? So take care of your veterans, and we know Veterans Day is coming up. So if you're a home buyer out there and your realtor or your lender do not ask you if you have honorably served in the military, then you ask the question yourself, or you come find one of us that really appreciates our veterans, because we love that. And there's a third kind of government-backed program which is very applicable here in Cabarrus County and in lots of the Charlotte, North Carolina region. We call it RHS on the loan side, which is Rural Housing Services, but in the public we call it the USDA loans. And see, just like y'all, I used to think that was only the meat rating at the food line, but now we know that USDA loans are actually backed by the U.S. Department of Agriculture for rural properties. So tell our viewers a little bit about the USDA loan and how they know to ask about it and where the benefits are.
So the benefits are going to be outside of city limits for the majority. And that's where USDA properties are going to be qualified. Properties qualify themselves for USDA. You can't qualify as an individual. So let's say you, Leigh, you want to buy a property USDA, you go across the street here in the city of Concord, and you say, I want to buy that house USDA. Well, if that house doesn't qualify USDA, you can't buy it USDA. So you're going to be looking for a property. Let's say we have a client who's looking for a property that's got a little bit of land out in the country. They want to be away from the city a little bit. A lot of times that property is going to be qualified for USDA, which means it's 0% down, 100% financing. But keep in mind, you're still going to have to bring some closing costs to the table. So it's not fully financed. You will still have to bring a little bit, but typically that's going to be minimal. But that takes care of your down payment for you. And with a lot of folks that we're dealing with, they don't have a lot of money to put down, which we'll get into some down payment assistance stuff here in a little bit. But that 100% down kind of helps some of our clients that are looking in those areas.
And don't trailer houses qualify for USDA financing if they're in that correct rural location?
Depending on the unit and depending on the lender. Some lenders won't finance single wides.
Will you finance a single wide?
We will not finance single wide.
It's got to be double wide?
It's got to be double wide. It needs to be attached to a permanent foundation.
So if you're buying a trailer house, we're going to ask extra questions, y'all. We have to make sure the DMV tag's been canceled. We have to check the foundation type and then single wide versus double wide. But it's still possible, and frankly, we don't mind trailer houses because, y'all, that's the original affordable housing, and it's a great option for a lot of people if you don't have a great big budget. We'll still help you find something.
Well, a good agent's going to dig deep, and they can find some good stick-built stuff out there too for them. So, you really want to sit down with your agent and kind of go over what you want, because your agent's going to be the one that sits down there and they dig into the MLS and they find those properties that are out there for you, because you're not going to see everything on Zillow or Realtor.com. That's where your agent comes into play, and they're going to be very, very helpful. And I know that's where your team kind of excels. You guys can dig deep and really find that stuff out there that some of these clients don't even see before it hits the market. So you really need to call your agent, speak with your agent, let them know what your property needs are. But your agent's going to want you to be pre-approved first as well.
Yeah, I'm glad you said that, because there's a lot of language out there. There's pre-qualification, there's pre-approval, there's approved. All they need is a contract. So tell our viewers, what are the difference in these terms? Which one means anything?
So pre-qualification means that your lender has sat down and had a conversation with you, and they've asked you what your credit score is, and they ask you what your income is, and they ask you what your assets are that you're going to bring to the table. So you verbally told them everything that you have. They haven't pulled your credit. They haven't looked at your documentation showing your pay stubs and your W-2s. They don't actually see on paper what your income is, and they haven't looked at your bank statements. But they're going by your word, and they're saying, if all this is correct, you'll be good to get a loan, so they'll issue a pre-qualification.
So what if I'm a bald-faced liar? I am a chronic liar, and I say, Joseph, my credit score is the highest one that exists. I'm pretty sure it's a 900, and I make $14 million a year net, and I can buy anything I want, and I have all this, and I have no debt. I don't have an ex-husband anywhere. I don't have any kids. So I could totally lie to you, and if you're a lender who wants to, you could write me a pre-qualification letter.
That's correct.
Look, y'all, that's why we tell y'all they're not worth the paper they're printed on. Not everybody is honorable. Now, I wish that they were, but we've got to work on that here in America. Not everybody's honorable. So if you can tell a lie and get a letter, y'all, I'm not going to make this up. I don't know if you even know this story. Last week, one of our lovely buyers wanted to look at a house, and the seller said they required a pre-approval letter before the buyer came in, and the buyer got all mad because they did not want to have to go through all this for the seller, and we explained the seller is trying to protect their family from random people walking through. They'd like to know that buyers have gone through the hoops first. So this buyer sent a pre-qualification letter. It wasn't even a bank. It was their best friend's last name, and they made up their own letterhead. And I knew the buyer well enough to know who the best friend's last name was, so we called them out on it, but it was a crazy situation, but that kind of stuff happens, and I get it. This buyer didn't want his credit score pulled. He didn't want all his personal financial stuff looked at because they're not ready to pull the trigger quite yet. But you've got to think about the seller's needs too. When you're the buyer, we're not just asking your stuff to dig on you. We're trying to make sure that we protect all parties in the transaction. So we've established that pre-qualification is not worth squat because people tell lies. So what is worth something?
So a pre-approval letter is worth something, and at Guild we issue pre-approval letters for our clients. So what a pre-approval letter is, and your lender's going to ask you up front, they're going to ask for documentation. So let's say you're a W-2 employee. They're going to ask for
That means a normal working person, y'all. See, we talk in terms all the time. He means like me, I'm a 1099 because I'm an independent contractor. W-2s are normal people with a normal paycheck.
So if you correct. So if you receive a W-2, your lender's going to want to see 2 years of those. They need to see 2 years work history. They're going to want to look at 30 days worth of pay stubs to show that you're still working for that company that you're claiming to work for. And they're going to look at 2 years of bank statements. So they want to see that you have that income, you have those assets, and that you are indeed telling the truth. So after they review all of that, they're going to put all that into the system, and they're going to run it through what's called a desktop underwriting system, which evaluates you as a client. It's going to look at your credit report, it's going to look at your score, it's going to look at your liabilities and your debt to income, and it's going to make a determination on whether you are a qualified buyer or not. So once I issue my clients a pre-approval letter, that letter means two things. One, I'm going to get you closed on that house, and two, I'm going to get you closed on time.
So you notice he said 2 years of work history, 2 years of W-2s. So Joseph, let me ask you a question. Let's say we have a school teacher, fresh out of college, got a job here with Cabarrus County Schools, and they're ready to buy a house, but they don't have 2 years in the school system. Can they buy a house?
They can, because their time in school counts as work history.
So see y'all, again, this is where you can't make assumptions about your own life, because a lender professional is going to ask all of these questions and help you out. In fact, we love supporting our local school teachers because we're fortunate to be in a market where they can afford to buy and they don't have to rent forever.
No, they don't. And both my parents are in the school system, so I know the struggles sometimes with the school system, and we work very hard and very diligently to try to piece together a program and a way for a teacher to get into a home, because we know that it's best for you to get into something that's more affordable, and as we all know, a mortgage is much more affordable than rent.
So let's jump to a different end of the spectrum. We have a lot of doctors, because here in Concord we have Northeast Medical Center, which is part of the Atrium Network. And doctors, of course, come out of school with a bucket load of debt because medical school is not cheap. So how do doctors buy a house when they've got debt that way exceeds their income, even though they're moving into a job where they're going to have income going forward?
So a lot of the doctors and dentists that come out, they'll get into income-based repayment plans with their student loans, and lenders can use those, and they can count that income-based repayment. So that payment that they've determined by consolidating all of that debt, and they're going to pay it all back into one piece, they can use that. There are also a lot of loan programs out there for doctors and dentists, and that's what you need to inquire with your lender. You need to sit down and have a talk with them and see if that's going to be a best fit for you. See if that's the direction you want to go, because a lot of times these doctors and dentists are making a lot of money out of school, but like you said, they have that debt. So we need to sit down and look at what are you making out of school? What you're going to be guaranteed? Are you working for a practice, or have you opened your own practice? Because that can make a big difference as well.
So do you have at Guild one of these 100% doctor programs that are very prevalent in the Charlotte area?
So we have doctor and dentist programs, and I know there are multiple other lenders that have them as well. But you really need to sit down with your lender and determine what that program entails, and you need to sit down and have that conversation, because it's going to be individually based, and they need to take a look at your stuff first.
Okay, so we have a lot of people in our area that have found something on the internet that told them they ought to do a lease purchase, rent to own. Talk to us about that for a minute, Joseph, because I know as a realtor professional that approximately 99% of those wind up failing.
They do.
So when you're a lender and you talk to somebody and they say, we want to do a lease purchase, what is your advice for them, and what questions should they be asking?
Well, it kind of falls out into.
You rolled your
how
eyes.
much
Look,
do
he
you
didn't mean to
trust?
roll his eyes, but for real, y'all. Lease purchase does not help you as a buyer. You have got to know that is a program that is set up to benefit the owner of the
Yes.
property. That's why he rolled his eyes. I restrained. Just notice, I was the restraintful one. Joseph was the wholesome one over here rolling his eyes. So what do you tell somebody? What should they be thinking
You're
about?
still going to be paying more than you would for a mortgage. They're
honestly.
factoring in some type of maintenance cost into your payment. So even though you're leasing to own, you're still paying for that landlord to maintain that property and put money in his pocket. Because essentially, as we all know, you're probably paying $150 to $200 more a month, and he's putting that into a bank account. And if something goes wrong, yes, he's going to have to fix it. But if nothing goes wrong, that's just profit for him.
And pay attention,
Right.
y'all, because on lease purchase, typically that down payment amount is non-refundable. So if you had 5% down saved and you went and did a lease purchase, if you don't fulfill the purchase, you've lost your down payment money. So our advice to you is to talk to a lender professional like a Joseph, and then think about whether you just sit on that down payment, put it in money market if you can't buy today, and go ahead and rent until your time is right, or do you go ahead and pull the trigger? And sometimes you need to wait a little bit of time, and that's what we may tell you. So sometimes you're going to reach out to us and we'll tell you to wait 6 months or a year, and then we'll help you get into a property. But what are we going to tell them in that year's time frame, Joseph? Do you give people a checklist of what they should do and how they could accomplish their goals within a set time frame?
I do. I give them a general idea of, in the price range, what they're going to need to bring to the closing table whenever they do buy a house. But also I give them some direction on how to improve their score over that time, because even if you have a 700 credit score, if you can get it to a 750, you're probably going to get a better rate. You're going to get cheaper mortgage insurance if you're going less than 20% down. So if you're still building up and you need a little bit of time to save up some money so you can afford to buy that house, even if you decide to go with a down payment system, let's say you don't have anything. That time could be well spent building that credit up to where you have an even better score when it is time to buy.
Okay, so let's tell our viewers the biggest mistake you see buyers make at any point in the home buying process, whether it's thinking about buying a house, it's the under contract process, or it's the day before closing time. What's the biggest mistake you see all the time?
So I'll go through each phase of that. The biggest mistake I see when people are looking to buy a house is not asking questions. They're not reaching out to the professionals and saying, hey, I have a question. So especially with millennials, I'm part of this, and I kind of fall subject to as well, but we want step-by-step directions, but we want it to be handed to us as well. So you have to reach out and you have to say, look, I'm ready, what do I need to do? What is the process on this? So one, don't be scared to ask and get the process started. You don't commit to a lender by just talking to them, and you don't commit to them by filling out an application and getting your credit pulled. That's just the start. Once they get into the process, the biggest thing that I'm seeing is people going and buying furniture and establishing new lines of credit, buying a new car, changing jobs. You can't change anything once that process gets started. It has to stay the same until you're closed on that home. After you buy your home and you're closed on that house, go buy the furniture you want. Go buy a new car if you want to. But make sure you can still afford that monthly mortgage payment along with your new car and your new furniture that you financed and everything, because I've had clients that bought furniture, and the day before the deal, they're going to look at your credit again. They're going to pull a pre-closed credit report, and if they see something new, it could kill the deal immediately.
Did y'all catch that? That's an often underknown. It's a kind of a secret part of the process. It's not a secret, but people don't pay attention. Right before closing, your credit's going to be checked one more time to make sure that things haven't changed dramatically in your life. And in my 18 years in real estate, I have seen so many closings derailed by buyers who were driving by rooms to go, and they said, oh, well, I'm moving this week, let me go buy a whole room full of furniture, and they did it on credit, and it's 12 months same as cash. And they said, well, same as cash doesn't count. Yes, it does. Same as cash does count. So do not go shopping and get that 20% off at Ann Taylor. Do not buy the room full of stuff and rooms to go. Do not go near Ben Minot and buy the GMC. Do all of that after closing. Y'all, it is so critical that you be disciplined enough to hold tight. And speaking of discipline, Joseph mentioned that after closing, you've got to make sure you can manage all these new monthly payments. I've got to tell y'all, The house payment is kind of an important one. And when we look at when people get sideways on their houses and when they get behind on the mortgage, it tends to happen in December. And y'all can guess, they went and bought toys for their ungrateful children instead of paying the house payment. Do not do that. If you cannot afford toys and the house payment, pay the house payment and go to Ollie's or Big Lots and get an inexpensive toy. Or actually, my favorite thing to do is trade with a friend, because if you take a box of your toys to a friend's house and get a box of their toys, your kids will all think it's brand new. Just put a bow on it. They don't have the foggiest idea, but pay the house payment. The other month people get delinquent is in July, because people would prefer to go to Disney than make the house payment. But y'all, make the house payment. You can go to Disney later, but we know this from history. When you get behind by 1 month, it's really hard to catch up, because that's a big chunk of money.
It is. It is a large sum of money. And a lot of our clients are asking how do I pay my mortgage off a little bit quicker too once I establish it.
Love that. There's an easy way to do it, and it does not involve that junk mail y'all are going to get, because you get this crap in the mail after you buy a house that promises you all kinds of insurance. Actually, it scares you and says if you die tomorrow, who's going to pay off the mortgage? And I throw those away because I don't like hateful scare mail. But there's stuff that says, we'll charge you X dollars and we'll help you get your note paid off early. Look, we're fixing to save y'all a pile of money, because you don't have to do that. It's real easy.
It is. So let's say you have a $1,200 a month mortgage payment, and you're paying that once a month. And instead of making a lump sum payment, which is very hard for a lot of people to do, it's hard to take $1,200 and add it on to another $1,200 and you're paying $2,400 a month out. Divide that payment by 12 and add that onto your monthly payment. So instead of making a $1,200 a month mortgage payment, make a $1,300 a month mortgage payment. And what you'll see is over time, you're not paying for that loan for 30 years. It's going to drop that down drastically, sometimes 7 to 9 years.
Did you hear that? You can turn a 30-year note into a 23-year note by making one extra payment a year. That's it. Now, one recommendation I'll make, because I have seen banks make mistakes, and I'm not going to say that 𝑔ILD does, but they make mistakes. You write one check for your $1,200, write the other check for your $100, and put on the memo line additional principal. Do the same thing if you're online banking. Add the memo line, but make it as 2 different numbers. It will help them make sure it credits properly, because if you get the wrong person keying it in and they just add it into the payment, it won't have the same effect over time. So just do 2 separate payments. And if you don't write checks, again, online banking, do 2 different line items. It just helps them, helps you.
It does. It does. I do want to jump back onto one thing that we kind of touched on earlier, is people that are coming to us and they have great credit scores and their debt to income's good, but I don't have very much money in the bank. I've only got a few $1,000. I've got $3,000, $4,000. How am I going to buy a house? You know, 3% down is very cheap, but when it all
not
comes
if you
down
do not
to it,
have 3% down.
No.
$1 is not a sale if you do not have $1. We understand that.
So here's the question that nobody asks is, how can I get help with that? And
Do you have help at 𝑔ILD Mortgage, Joseph Baker?
we do. Through
Da-da-da.
South, I do North Carolina, South Carolina. If we have viewers that are watching this from outside of those areas, your state probably has assistance as well.
Just send me a private message if you're outside of North and South Carolina, and I can connect you to a realtor professional in your area who will help you find somebody like Joseph, because almost all the amazing professional realtors, we have really great people. So let's just talk North and South Carolina.
Okay.
What does our amazing buyer do with no money but a good story otherwise?
So let's say they have a 700 credit score, they have a 30% debt to income ratio. North Carolina Housing provides a program that has $8,000 of down payment assistance that you can apply directly towards your down payment and use some of that towards closing costs as well. South Carolina has a similar program of $6,000. And these South Carolina Housing and North Carolina Housing, they have programs that kind of come in and out as well. We also know about the CPLP, but that's a fund limited program, meaning that typically halfway throughout the year they're out of funds and they're not going to refresh until the beginning of the year. South Carolina Housing has a phenomenal program that lasts about half the year because it's a funding limited program as well, but it's directed towards our firefighters and our police officers and our medics and teachers. And these are big time programs that can help people get into a house without having to put a whole lot of money into it. And depending on what your income is, it could be forgivable or it could be non-forgivable. And what the difference is forgivable is they're going to say, we're giving you this money, and as long as you live in this house for a certain amount of time, you don't ever have to pay it back. Non-forgivable means that you're going to have to add that payment into your monthly payment, but it's going to be very minimal. But it's going to get you into a home, and that's the most important piece, is how do we get you into a home? How do we get you financed to where you can make an offer and get that contract accepted so you can start moving your furniture out of that rental and get into a house you want.
And understand too, guys, part of the reason we do promote home ownership is not to make you be stuck in an area forever, because there is an issue right now in our society where people are a little afraid of commitment. But you have to know that if you want to build wealth over time, if you want to have a decent retirement, owning property is one of the most stable ways of getting there, because the stock market is very fluid, and frankly, if you don't have a lot of money to put into the stock market, it's kind of hard for you to get anything out. Real estate gives you an opportunity to build wealth in the place where you live. And by wealth, I don't mean like billionaire wealth. I mean like you can retire one day knowing that pensions are at risk, Social Security is at risk, but this is how you can really build some stability. It's also been proven for years that children who are raised in homes that are owned do a little bit better in school. They're more likely to go to college, they're more likely to stay away from drugs and gangs and activity like that, because they've got stability. So when you're thinking about home ownership, consider all the implications for your life. When you're part of your community and you live there and you own property there, it changes how you feel about yourself, about the place where you live, and then you start doing more to make the area better. So we absolutely are proponents for home ownership over time. And when you're renting, that doesn't make you bad, but we want to help you figure out a path for your own future, because it's the best stability you can give yourself in the long run.
I think the best advice that I got when I was first starting into my career stage was buy a house, because you're going to have a 30-year note, and that seems like it's going to take a long time, but you're probably going to be working longer than that. So by the time you retire, that's paid for. So if you want to go move down to the beach and buy a condo down there, you can have someone paying you money that you're not having to apply to a mortgage at all, that could be paying for your beach house. So that's where that investment comes into play, and that investment's not going to go away. These houses don't lose value drastically. It's not like buying a car where you're driving off the lot and you're losing $8,000 to $10,000 of value. When you buy that house and it's appraised for that amount, unless the market completely crashes and everything,
which it did, and it could do it again. We know this is not a permanent solution, but over time, historically, houses get better.
It could, but after the crash, the value of houses went up drastically, and there's a lot of people that make good money off of it.
And it's cooling off right now. So actually, if you're thinking of buying, right now is a great time to be thinking about it, because we're not seeing the big bidding wars we had even 6 and 8 months ago. And we expect to have a pretty balanced 2019. And I, as a realtor, love a balanced market, because it means sellers get a fair price and buyers get a fair price, and you don't have this unnecessary emotion kind of driving things. Now, before we jump off of our Facebook Live, you mentioned investment properties. Does Guild Mortgage provide mortgages for investment homes?
We do. So if you're going to buy a home and you want to turn it into a rental, we have programs where you can put as little as 15% down. Most people think you have to bring 20% to buy an investment property, and you don't have to. So those options are out there as well. You are going to have to be a well-qualified buyer. We need to show that even if you didn't have a renter in that home, that you could afford the mortgage on that rental property and your own.
Those are called reserves. So you'll have what's called a reserve requirement when you're buying investment properties. And as Joseph said, you're planning for vacancy time, but you're also planning for maintenance, which he mentioned a little bit ago in talking about lease purchases. That landlord's dealing with maintenance. You'll have to deal with that as a landlord yourself, but it's well worth it, because you're then able to leverage your opportunities and provide a good home for somebody else. There's a real benefit to having good rental properties in the market for our renters. So we don't recommend that you become a slumlord and be gross and terrible. We recommend that you think about a property that you could make available, and rents don't show any signs of slowing right now, and as markets cool, rents tend to stay stable or even go up.
But we also need to remember, get into your house first. So get your principal residency first. I get a lot of buyers that are calling, they're renting, and they want to buy an investment property. So you're being counterproductive at this point. Don't fall for the quick, the magic pill seminars that everybody's putting out there. How can you make money on investment properties? You can, but make sure you're taken care of first.
But seriously, y'all, if it's a get-rich-quick seminar held at a local motel, that is not something you should put your money into. So resist, and call us
Yes,
and buy
please.
a house. Now, I will say, though, if you live in California, you might not be able to afford a primary residence, and so then you might buy rental properties in North Carolina because it doesn't work in your market. And so that's a different scenario. But again, we'll walk you through anything going on in your life. Joseph, you got any last things you want to tell our audience before we let them get back to their productive Tuesdays?
No, thank you for being here, and give us a call if you need anything, even if it's a simple question. I'm here to answer questions just as I'm here to get your files. So if I have a client that just calls me and they have a simple question, they say, hey, I'm just thinking about getting into the market. I just have a basic question I want to ask. I don't charge for questions.
And y'all, we're not going to be able to retire anytime soon because we're way too young for that. So we'll be here for you no matter what you need. If you're anywhere near Concord, pop in and have your Instagrammable moment here in the Betty Feaser kitchen. We'd love to see you. But thank you for being online with us today, and we will see you next time from the Betty Feaser kitchen.